Hello, everyone, and welcome back to the BlackGirlOption Podcast. My name is Kayla Salem, and I'm your host. With each and every episode of the BlackGirlOption Podcast, you all will be listening to me learn and discover new lessons on my path to being a consistently profitable trader. So thank you all for tuning in and enjoy the show. So, hello, Greg. Thank you for being on the BlackGirlOption Podcast. I appreciate you coming.
Hello. Thank you for having me.
Okay, so before we start talking about trading and investing in the stock market and things like that, I always want to make sure that my guests or my audience members know who we're talking to and just to learn a little bit about you. So tell me a little bit about yourself. Where are you from? Where did you grow up? What do you do for a living? Those kind of things.
Well, I'm Gregory Collier, and I am a trader, investor, analyst, and author. I grew up on the northwest side of Detroit, Michigan, and I now reside in West Palm Beach, Florida.
Florida. Me too. I live in Tampa.
Okay, Tampa's very nice.
So, yeah, we got nice weather. You know, it's the winter time right now, but we're living good pretty much.
Absolutely.
Yeah. So what are some of your interests? What are some of your hobbies? Like, what do you like to do in your spare time when you're not trading?
When I'm not trading, I enjoy having fun. I like spending time with my wife and son, and I'm quite active on social media. I have fun with social media, where I give a lot of trading advice and life advice at no charge. My son is a basketball player, so I spend a lot of time working with him on basketball, and more time.
Yeah, I see that on your Instagram.
Yeah, he just fell in love with basketball from a young age, so I support him. So he plays basketball and he does taekwondo. He's a second-degree black belt in taekwondo, so I spend a lot of time on athletics with him.
Wow. Well, I actually used to play basketball. I'm sorry.
His mother spends more time with him on the academics. I let her be the bad person, and I have more of the fun. But I am, if he's not doing what he's supposed to do, I am very disciplined in making him focus on his academics.
That's cool. I used to play basketball in middle school, and then I was so little I got intimidated, so I stopped playing in high school, and so I ended up playing flag football in high school, and I played flag football all 4 years. It's pretty good.
Yeah, flag football. Flag football is great.
Yeah, so you say your son's in Taekwondo. So does he? Has he ever seen Cobra Kai on Netflix?
He's never seen it.
Oh, you guys, you might gotta watch it. I mean, it's a little. You might want to watch it with him because it can be probably PG-13-ish. But I highly recommend it if he's into Taekwondo. I mean, they're doing karate, but
I'm sure he would. I'm sure he would enjoy it, but he's never seen it.
Are you familiar with it?
No, I'm not. I'm not really. Not really a TV watcher. I really.
I feel like you would like this one.
I primarily watch sports, and then some news. I rarely watch movies, and so same thing goes for my wife, and same thing for my son. If he's watching TV, he's mostly watching sports.
He would like Cobra Kai because it's about. Have you ever seen the Karate Kid, the original ones? So it's the same actors, and they're just older now, and they're teaching their kids and younger kids karate. So it's really, really good. I think if you don't watch TV, that's a good one to watch. And it's kind of like family-ish.
Okay.
You know? So
that's great.
Okay. So how did you first get started in the stock market? How old were you, and what made you get into the stock market?
Well, going back to probably when I was in high school, I made the decision that I was going to be very well off financially. And I made a decision that the stock market was going to be one of the tools that brought me some good financial success. And so it all started back in high school, just hearing things about the stock market, learning what the stock market actually was, and then I progressed from there. and I got more. I started to get active in learning more while I was in college, and I geared my career towards finance.
And did you start investing first before you started trading?
Yeah, I definitely started investing before I started trading, because I started investing for the long term as soon as I actually started to make some money. When I was in college, I was broke, so I didn't have capital to invest. But once I graduated and I got my first job, initially I started investing, like many people, as part of my 401k. And then I opened up an additional brokerage account, and I started putting some money here, some money there into it, and just watching it grow over time. So I got into investing for the long term first, and that's usually the natural approach.
And so when did you first learn about trading?
Well, I had heard of it because of, various maybe movies or things that were presented in the media. And when I was in college, that's when I started reading the Wall Street Journal on a daily basis. And I really got exposed to trading in my first job. It was really, I don't want to get real religious, but it was just by the grace of God. It was just, I had, after I graduated from college, I made the decision I was going to work in the financial services sector, and I decided to go to New York City. My family is originally from New York. And I got a job as a customer service representative at a bank. I don't even know if it's still around. First Chicago National Bank. But it was national, so they had a customer service office in New York City. So I got a job working as a customer service representative at First Chicago. And it wasn't going to start for a couple of weeks. And I got a call by a temporary agency asking me if I was interested in doing a 2-week temporary assignment. They said it was below my pay grade. I said, sure, I'm not scared to get my hands dirty. I decided I'd go ahead and I'd do that temporary assignment until my job started. And it was on a trading floor. It was on a trading floor. It was on an institutional fixed income trading floor. For the time, it was Manufacturers Hanover Trust Company, which in the 1990s, there was a bunch of big bank mergers that merged with Chemical Bank to become Chemical Bank, which ended up merging with Chase to become JP Morgan, to become Chase Manhattan Bank, and then it's part of the legacy entities that are now JP Morgan Chase. But that was on fixed income institutional trading floor, and that's when just a light bulb went off in my head, and I was like, wow, this would be a great opportunity for me to learn. So when that initial 2 weeks was up, I was asked by the person who was my supervisor if I wanted to stay on. And said, he liked that I could do a lot more than what the job specified. And so I ended up never going to First Chicago. I ended up staying at Manufacturers Hanover Trust Company because I saw it was such a great opportunity for me to learn. Yeah. Ultimately, I was hired full-time, and it ended up being a pretty decent early job in my career. But that's where I first got exposed to trading. And
this wasn't a hedge fund?
No, it wasn't a hedge fund.
Prop trading
this was
fund.
Back in the days where commercial banks were just starting to be able to take on additional activities that investment banks traditionally did. And it was while a couple of laws, a law was being eliminated called the Glass-Steagall Act, that was being eliminated. But Manufacturers Hanover Trust Company was doing investment banking activity. So these guys were active proprietary bond traders. And so that was my first exposure to trading. I got some exposure to equity trading later on. So I worked in an area that confirmed every trade that took place. So when a trade took place, the banks would send paper confirmations to each other via fax. And I was one of the people who would review those fax look at our actual system, and confirm that the details of the transaction were correct. So essentially every single transaction that was done on any day, I got to see. So it was very good experience early on in my career.
So it was done, the trading was done through fax, like so someone would fax you guys saying, hey, I want to buy X amount of stock.
At that time, technology was starting to advance, but the trading was done over the telephone. One trader would talk to a trader from Manufacturers Hanover Trust Company, would talk to a trader at ING Securities or Deutsche Bank or Bankers Trust, and they would do a transaction over the phone. Everything was recorded. And that trader would write out a trade ticket. Somebody would enter into a system, and then there was somebody at the counterparty who would fax something over to us to confirm the transaction. I would fax something over to them to confirm the transaction. So it was just a double check to make sure that we agreed on the details of the transaction. So that's how that was actually done back then, and that was the early 1990s. And as technology evolved, that process became more electronic, where you wouldn't actually need a human necessarily faxing something back and forth. Someone would just verify things visually on a screen and make a quick phone call to the other counterparty to confirm that, okay, we agree on the transaction. And if they didn't agree, you would reconcile the matter.
So now, looking back, and since you reviewed all of these trades, how would you describe in the 90s the trading style? Because you're saying that someone had to call in, and then you had to get the facts, and you had to review the facts. I'm assuming the style of trading was much different back then. Like, you couldn't scalp back then. You would have to, I guess, day trade or even, swing trade back then.
Scalping could actually be done, but scalping would be done in equities. So fixed income securities is not something that is as easy to scalp, if nothing else, just because of the size of the transactions. Being in a small transaction might be $100,000 back then. And so based on inflation, it's a lot bigger now, but typically the size of the trades were anywhere between $1 million and $10 million back in 1990. So scalping really wasn't done. These were all position traders. They might keep a position for half a day. They might keep a position for a week, 2 weeks, 3 weeks. It just varied depending on what strategy the individual traders would actually be using. But the systems for equity transacting were much more modern. Not like they are today, but they're much more modern. So one could actually buy and then sell a few seconds later if one desired. But this department was specifically just fixed income. I did get some corporate exposure to equity trading later on. But how I actually got the idea for myself, trading on my own account with my own capital, is in 1994, after the Chemical Bank merger took place and the name was officially Chemical Bank. Chemical Bank sent me to London to cover for a trading assistant who was on vacation. Just a trading assistant would be one who simply assists a trader, whatever trader happens to be doing on a particular day. Answering the phone, reconciling discrepancies, even entering a transaction into the system that happens to be using to track the trades. So while I was there, my mother, who was a real estate agent, wanted me to reach out to one of her clients who was a British citizen. So I ended up doing that. It ended up meeting the gentleman. It ended up that he was a former institutional foreign exchange trader who had retired, but he still did some FX trading, but he did it from home. And he did it on his own account with his own capital. And this was the point in time where the internet was becoming more mainstream. Even back in 1994, most people didn't have a computer. If you had a computer, you definitely had a lot of capital to be able to afford one. And most internet connections were just slow dial-up connections that were unusable relative to the current technology. But that's when I first discovered and thought of the fact that, hey, at some point, this is something that I could do on my own. And my plan was I was going to work a corporate career until I had determined that I was going to leave corporate America by the time I turned 53, and then whatever else I did the rest of my life, I would just trade on my own account with my own capital. And I ended up leaving corporate America around the time I was 40, just prior to the global financial crisis, just because I saw such great opportunity. And I wanted to move from New York City to South Florida. And that helped me make the transition to South Florida. Being that this is more of a hospitality state, this is not a place where there are as many opportunities to do what I did in my corporate career in New York. And since then, it's technology has grown so much that now you just have people, anybody can just become a trader. Just open an account, put some money in it, and you can start trading.
Yeah. In as little as a couple of days, you can just start trading, which, it has its pros and cons. The sort of easy barrier to entry. There's no barrier to entry to trading.
There's no barrier to entry now.
It's a free for all, but high risk is high reward. So you started at this sort of company where you're trading with these positional traders, these banks, these big corporate entities, and then you move to Chemical Bank. Along that time, you were learning about trading and those things. How did you find your strategy? Did you use the strategies of these traders, or did you kind of just develop your own strategy?
The strategies of the traders at Chemical Bank, since they're mostly position traders, that was not something I wanted. I could have used that strategy, say buying Apple on January 1st and wanting to hold it until January 15th and selling it if it's profitable, or adjusting my position if it's not. That's more of the style that the guys at Chemical Bank use. But later in my career in New York, I worked for a company called ING Securities, and I was actually an assistant on an equity trading floor. And so I got more strategies that were more conducive to what I do now. And I had access to, I sat right next to an algorithmic trading desk. And one thing I noticed, I'm primarily a gap trader. So I'm usually done by 11 a.m. So I'm really trading, for the most part, the gap between the previous day's closing price and the current day's opening price, based on the premise that gap is likely to close. So if Apple opens up 0.5% lower than it closed on the previous day, my expectation is that Apple is going to rise in price and meet where it closed on the previous day. Well, this algorithmic trading desk, they had multiple people. There was one guy, and that's all he traded was gaps. He traded gaps on multiple securities, and he was done every day by 11 a.m., and he made a lot more money than any other trader on the desk. And he would simply sit there the rest of the day and read a newspaper and just watch to see if there might be some potential additional opportunity, but he rarely traded after 11 a.m. So that is where I actually got my primary style, gap trading, from watching what took place when I was at ING Securities.
Okay. And so how did you develop your own trading psychology?
So,
because we know there's the trading, your mental health and your trading psychology is such a vast discipline in trading that I think needs to be more. I consider myself a trading psychology advocate. Like, I feel like it's something that's neglected.
Yes.
So how did you develop your own trading? Like, what is your process, and how did you realize that you needed to focus on that before you could become even more
I agree. Trading psychology is definitely neglected, and the X's and O's, one can learn a couple of simple strategies fairly quickly, but just greed and fear causes people to make massive blunders in their trading. And no matter how experienced someone is, I mean, I still deal, being experienced, I still deal with trading psychology issues. And what I did to significantly get over it is, number one, I did a lot of practice under pressure. So just years of practicing with various size transactions relative to the amount of capital I used to trade. And I worked on trying to become consistent, irrespective of whether my first trade of the day was a losing trade or whether it was a positive trade. So a lot of times I would do very well in the morning, and I would keep trading in the afternoon, and I would lose everything I made in the morning just because I was so excited that I did well in the morning. So to essentially master trading psychology, which I don't know if you can really master it, but you can control it significantly. What I did is I started to just stick to a daily trading plan. So every morning I write out what my plan is, what I plan on actually doing. And if I stick to my plan, I take emotion out of the process. So, for instance, my plan on this Friday that just passed, I saw that Apple and the market was down really about 1%. And then it started to rise maybe 20 minutes to 15 minutes before regular market hours started at 9:30 a.m. Eastern Standard Time. My plan was also Apple had gotten a large upgrade issued by Loop Capital. So my plan was I was going to look for Apple to rise in price and try to fill the gap from the previous day's close. And that's exactly what it did. But also as part of my plan, I am usually, if I'm in a position, unless things are surging, I get out by 9:55 a.m. So I ended up getting a very nice gain. And at 9:55 a.m., I closed my position out. And then at about 10:05, Apple started to pull back. SPY started to pull back. The NASDAQ started to pull. Everything started to pull back generally at about 10:05 that day. So I ended up not trading again that day. So if I stick to my plan, I'm usually going to be successful, and I take emotion completely out of the process. Because at the time I sold Apple at 9:55 a.m., it was actually still rising. Had I been greedy or had I not stuck to my plan, I could have very well held for another 10 minutes, and then when it started to pull back, I would not have been able to get out as profitable as I actually did get out. Now, I traded options, call options, but had I traded equities, it's easier to get in and out of equities than it is options, obviously. So I might have been able to hold if I was in equities, but I was in stock, but I was in options. So I stuck to my plan. And that sticking to a coherent trading plan and not deviating from it, in my opinion, is the best way to keep your emotions in check while trading.
And how did you swing those contracts, or you got them early? I
bought those early in the trading session. So the 9:30 a.m. bell rang. I watched some volume come in. I went in and I bought some call options. I bought a few more, and price went back and forth. I added a little more on a dip, and then it just took off and it just kept going, and I walked away with a nice win.
And how do you handle, you stick to your trading plan, but how do you handle sort of those pullbacks? So let's say you got into that trade and, it starts to pull back because, prices, constantly fighting, it's constantly consolidating. How do you handle
That's
those?
the hard part, because sometimes when emotions do go against me, what I do is I don't follow my trading plan, and I hold. And when I do that, that ends up being sometimes being a bad loss. More often, it's a bad decision. When I'm trading near expiration options, and in this particular case, I was trading 0 day to expiration options. So I was trading the option to expire that same day. Generally, my policy is on near expiration options. Once I hit negative 20%, I have to close it immediately, and that's generally what I do. So I don't do that all the time. It's generally what I do. If I'm trading options that are 1 week out in the future or 2 weeks out in the future, I cut that mental stop, because I never enter hard stop losses for options. I only have mental stops, so that I don't end up getting taken advantage of by the market maker. If it's further out in the future, like a week or 2 weeks, my mental stop will be 10%. And if I always had employed that strategy, some of the big losses that I've incurred over my trading career, I would not have incurred. I actually can't say some of them. I say almost all of them. There are a few that once in a while the market just does something completely just that no one expects. Just has, not like a flash crash, but just a massive move against you that you just did not see coming. There's no way you would have seen it coming. In those cases, you just have to. I just take the loss, and that's where position sizing comes in, because I should never ever be. I can never ever do a trade that's going to cause me to destroy my entire account or most of my account. Any trade I do, if I were to lose, particularly with options, if I were to lose 100% of it, it has to be small enough relative to the capital I'm trading with that within a day or two I could make it up under most circumstances. In worst case scenario, I could make it up within 1 calendar week.
That's my biggest sort of issue, is handling those pullbacks, because I just recently read this book called The Mental Game of Trading. It's by Jared Tendler. I actually just interviewed him, and I asked him, what's the biggest emotion that traders face? Because he's a performance coach, so he talks to traders all the time, trying to get them to become better traders. And he said the number one emotion that traders struggle with is fear. It's either fear of losing money or fear of being wrong. And I realized I definitely have that, especially when those pullbacks. So, I stick to my plan. I have a plan every time I trade. Okay, I'm going to get in at this point. And then for whatever reason, because prices, constantly fighting, I get that initial pullback and my heart starts to race. And I'm like, oh my gosh, I'm wrong. And that fear sort of creeps up into me. And then I kind of like forget my entire trading plan. I'm like, oh my gosh, I have to get out because I'm down this, however much, percentage wise. Right. And then I get out the trade. And of course, if I had just stuck to my plan, it hadn't hit my stop loss yet. If I had just stuck to my plan, I would have been profitable in the trade. I just needed to take the patience. But that fear creeps in.
That drives me crazy, and that's happened to me more times than I can possibly explain. Which is why I try to stick to my plan, and if I can keep that loss on a near expiration option to a maximum of 20%, when things settle down and I can see another clear opportunity to win, I can do well. The biggest, when that fear sets in and I have a big loss, what has really caused me to have problems is being stubborn enough not to cut the loss. Or if I end up cutting the loss and it's bigger than I wanted it to be, I dive back into the market faster than I should, trying to make up for the loss. So that's probably the second biggest mistake, trying to make up for a loss. Because ideally, I want to look at every situation different. I want to look at every potential trade that I do as a new opportunity to succeed, and not necessarily to make up for a loss. Though I've been very good at, when I'm down big, I've been very good at finding a trade that makes up for a big loss. But I can't count on that happening all the time, so it's better just to avoid that big loss and keep it as small as possible. Because irrespective of whatever strategy someone uses, you're going to be wrong. It's not going to work. It might not be anything that you particularly did. It could be some news that came out that caused things to go the opposite direction of what you expected. So, it's and this is why trading is so difficult. This is why they say more than 90% of the people who trade in the short term fail at it. It's probably more than 95%. And it's some of it is because people just lose hope. Aren't adequately trained because the barrier to entry is so small. Most people, if they get adequate training, and the biggest part, emotions, understanding how to manage their emotions while trading, a greater percentage of people would be able to achieve a level of success at it. And that's just my take.
Yeah, I agree wholeheartedly. So I'm sure, since we're both traders, we're mostly aware, trading is you're constantly learning. There's no one way to trade. There's no right way to trade. And the stock market is constantly changing, and the conditions and these hedge funds and these sort of market manipulators, something's always happening in the market. What books would you recommend to new and up-and-coming traders on just to educate themselves wise? Books or a YouTube channel?
Well, I have a YouTube channel, Gregory Collier TV, where I go over my trading style. And it's been quite helpful to some people. I've had people who had a gentleman who was down 90% in his account, and he was able to make that back in about a year, and then he grew it to a 300% profit from where he initially had started at, just using a style that I use to remain consistent. And what I call it the ATR trailing stop strategy for trade entry. And this is something that an institutional trader who I worked with, who retired, started trading, and he said this is a great way to stay on the right side of the trade. And I just kind of adapted that, and I use that often in unison with gap trading. But for investing, The Intelligent Investor by Ben Graham is a phenomenal book. Beating the Street by Peter Lynch is a great book. Peter Lynch and John Rothschild is a great book. Stock Strategies and Common Sense by Bart DeLido, who is the founder of VectorVest. It's a very good book. And it's just, those are all about investing. In terms of books on trading, short-term trading, the absolute best book I've read was a book called Power Trading, Power Living by Michael Parness. There are a few things in the book that are out of date from the standpoint that the uptick rule no longer exists, at least in the fashion that it previously existed in that you couldn't short a stock unless it had ticked upwards prior to you shorting. That rule no longer exists. And also, it used to be that with options, you did not exceed the pattern day trader threshold unless you did more than five trades in a rolling 5-day period. And now it's more than 3, just like stocks. But the book is still phenomenal. There's 2 entire chapters on gap trading, and that helped solidify my knowledge base on gap trading. But it also goes over technical analysis. It goes over some of the games that market makers play. It goes over reading the tape, looking at time and sales, which is looking at time and sales and level 2 quotes. And it's just a phenomenal book. And I refer to it from time to time, especially if I go through a period of where I'm not trading very consistently. I'll go through my notes in that book and Power Trading, Power Living, and it'll get me right back to winning consistently. And my Instagram handle is optionsbook, OPTIONS book, and I have these books and more listed in my highlights. So Power Trading, Power Living, mentioned stock. The great book called The 4 Biggest Mistakes in Futures Trading by Jay Capel, Kaeppel. Now, everybody doesn't trade futures, but the risk management that is talked about in this book is applicable to any type of trading. And just for clarity, I trade stocks, futures, options, and I also trade binary options. But I primarily, what I trade the most are options, listed options on equities and ETFs.
You were describing your trading style, because I've seen a little bit of it through your Instagram, the ATR trailing stock strategy. Yes. Could you describe it a little bit? Like, what does that
ATR stands for average true range, which is a measure of the degree of price variability of a stock. And one particular method of exiting trades that a lot of traders employ is having a trailing stop. And the trailing stop is set by the average true range. So that particular type of stop is called an ATR trailing stop. But what I use it for is I don't use it to exit a trade when, say I'm going long. I don't use it to exit a trade when the stock pulls back. What I do is, say I'm going long, if the ATR line is above the price, once it breaks the price to the upside on a 5-minute chart and the 15-minute chart, that's a signal for me to go long. In some cases, these break out and just keep going significantly higher. But in other cases, that's an opportunity, say on a weekly option, to nail a 10 to 20% gain on any individual, or more, on any individual trade. And that's what I use it for, because what happens is that ATR trailing stop line is like a resistance line. And once it breaks that if it's above price, it's like a resistance line. Once it breaks it, often a bunch of buyers come in and push the price even higher. And that's the basis of the strategy. And the exact opposite, if the ATR line is below the price, it's like a support zone. Once price breaks below it, a flood of sellers come in and push it even lower. And
you can short it or, buy
right.
puts.
A lot of times it will coincide with pivot points, support and resistance, S1, S2. But a lot of times it won't. but it works no matter what. So it just is like when people use pivot points, they're generally they're created based off of the previous day's price action. Well, the ATR adjusts throughout the day. So similar to how the Bollinger Bands work, they adjust throughout the day, and based on how the price moves. And so that is, because the strategy is so simple, that is why it's done so well. It works for me consistently. I don't have to look at a bunch of other indicators. I don't have to volume and how the price is moving generally are the best indicators, in my opinion. But where the ATR line actually sits, the ATR trailing stop line actually sits, how volume is flowing and how price is actually moving is factored into where the line actually sits. So it's, in my opinion, it's just a great strategy. And there's a link to my, on my Instagram page in my bio, there's a link to my YouTube page. And I've got multiple videos on the ATR trailing stop, how I set it up. I use it primarily in Thinkorswim and TradingView, and I show exactly how I set it up in Thinkorswim and how I set it up in TradingView. And I give some actual trade examples in some of my videos. I think I have like maybe 4 videos just on the ATR trailing stop. I've got another comprehensive video on gap trading and a few other tips on my YouTube page, which is Gregory Collier TV on YouTube.
Definitely people need to go and check that out. So what's the average time that you hold a position?
It varies, but typically I'm done by 11 a.m. at the latest. So if I enter a trade prior to 10 a.m., I'm in those maybe 10 minutes at the most, because things move really fast prior to 10 a.m. The first half hour trading, last half hour trading, the moves can be super fast. So I'm not in very long, but I never count how long I'm actually in a trade. I just count how much money I make from it or how much money I lose from it. I've had some instances where, I was in a trade for 5 minutes and I made $5,000. And if I had held it all day, I'd have made $200,000.
Oh,
those are the ones that hurt, because I sit back and I'm like, wow, had I just held that, that would have been.
I wouldn't have had to trade for the rest of the month or the rest of the rest.
The reality is, I stick to my trading plan, and
that's the key.
I want to hit. I want to hit singles. I don't want to hit home runs. So when I hit a trade like that, I'm generally using up to about $20,000 in capital. That's generally the largest option trade I do. They can turn so fast that could if I can make $5,000 in a very short period of time, it could turn so fast it could be a $10,000 loss. So I generally get out, and I do not. If it just keeps going and keeps going, I might jump in. I might trade stock, or I might do another trade that's a little less risky. I might do a vertical spread that I might hold most of the day or even overnight. But I generally won't do it with a naked option. So I don't really count the time frame. But it's rare that I hold something all day, because most of the time I am trading either at the money.
You're scalping.
Most of the time I'm scalping, and I'm scalping at the money or one strike out of the money options that expire on the closest expiration date. Sometimes I push it out, but I rarely do that. So that's why that's why I generally need to be in and out fast. If I'm trading the next week's expiration, and maybe 1 or 2 strikes in the money, if price turns and goes the other direction, I'm not going to lose as much capital as fast as I would if I'm trading near expiration at the money or a strike price or 2 strike prices out of the money. And just on this Friday when I did very well, I chose an option that was 2 strike prices out of the money that I entered near the open. The 1 strike out of the money looked like it was about to get crossed potentially fairly quickly. So I chose 2 strikes out of the money. And I also chose 2 strikes out of the money because at least at that point in time, the highest volume option was the strike price I was playing. And the near expiration option with the highest open interest, which is it's updated before the market opens. It's not updated during the day, open interest, was the strike above the strike that I played. So open interest is often a magnet for price. Price often navigates towards the strike price with the highest open interest. So that's why I did that particular strike price. And that was a dangerous trade had things turned and gone the other direction.
Do you have a favorite stock to
Apple
trade,
is my all-time favorite. Tesla is number 2. Apple, the past 2 years, I've not traded it as much. But up until about 2 years ago, I traded Apple every single day. There was never a single day where I did not trade Apple, either trading stock or trading options. But on most days, I'm trading Apple. It's my favorite stock. It's also my largest long-term holding. And at one point in time, it had grown so much that it completely dwarfed all of my other long-term holdings. So I sold half of it. I bought some Facebook with half of the proceeds. I bought Facebook. The other half I bought Amazon, and the rest went in the S&P 500 index funds. I'd done better had I just held Apple, but it had gotten way too much as part of my long-term holdings from a diversification standpoint.
So what changed in the past 2 years that you said you used to trade it every day and now not?
Well, there's a period of time where the moves in Apple were just not as good as they had been previously. It stopped having as large of a daily move as it had historically in the past. So I didn't trade it as much. And then once we got into 2022, once we got into the aftermath of the drop due to the pandemic, and the market started to really surge, Apple started to really pick up. So I got into it much more often from that point going forward. But it Apple really drives. It's one of the main stocks that drive where the S&P goes on a daily basis. And there's so many people who are trading it, so many institutions that are trading it, so many algorithms that are trading it, that it is highly predictable and it's rarely erratic. Tesla is like the number 2 stock I like to trade, but Tesla is super erratic. You can have all kinds, you can look at all kinds of technicals and everything will look like it's perfect, and Tesla will completely change on a dime, won't even get to, say, a resistance level or anything, with nothing to do with technicals. It will just turn and move so fast that if you and their premiums change. If you had gotten in, oh my gosh, you'd end up getting destroyed. So I adapted my style with Tesla. I love it when I catch it would go straight up, but with NVIDIA would be the third thing I trade the most. They both have, NVIDIA and Tesla both have wide spreads. But for me, the key is, say I'm going along, because that's just the simplest way to explain it. And if the trajectory of the price moving higher starts slowing down at all, that's when I get out. I get out if I see the price slowing down at all, rather than wait for it to stop. Because if it turns and it goes against you, it's hard to even get out of the trade. You can have I've had 30% gains on Tesla and NVIDIA, and then it would turn, and I walk away with a 10 to 20% loss. So if the trajectory starts slowing down at all, I just get out. And that is, for me, has been the best way for me to play it. Certainly in the past year, without a doubt.
So in terms of your trading, do you find yourself talking about trading with your friends or your family, like your wife and your son? Like, do you encourage your son to trade? Do you encourage your wife to trade?
No, I almost never talk about trading unless I'm talking to traders who want to talk about trading. I don't bring it up. If I had a good day, no one knows if I had a good day unless if I posted it to Instagram, then people will see I had a good day. But I don't talk about it. If I had a bad day, unless I posted to Instagram, no one will know. I act exactly. I've had some brutal days where I did so bad, I don't want to even admit how bad I did. And I just acted like nothing happened, went about my business. And it was just a normal day. I try to be cheerful. It's just the way it is. But I don't talk about it unless people bring it up. If people ask me what I do for a living, I'll tell them I'm a trader. And they'll ask me what firm I work for. I tell them I trade on my own account with my own capital. I do not work for any firm. And if they want to dig in and ask questions, I'm happy to answer them. But I don't go out of my way to talk about it. Generally because most people don't understand it anyway. And also the rare few people who do understand it, most of them don't fare very well at trading, and I don't want to brag or anything like that. And if I sold a service, and I don't have a Discord, I don't sell mentoring services. Any information I provide online is 100% free. And I if I sold those things, I talk about it all the time. Every person I met, I'd have something on my car. But since I don't talk about it really. And the reason I actually give the free post what I do is, years ago I was on StockTwits, and I would get dozens of solicitations a day at minimum. People trying to sell me an alert service, telling me that they have a 100% win rate.
That's still going on.
And I decided, okay, let me take some money out of these people's pockets and start giving some real advice and real clarity on trading. And most of the ones who are doing the heavy marketing, most of them are losing traders. There are some who are actually very good traders, and whose services actually do teach people how to trade well and properly, and with good risk management and good trading psychology. But that is the minority. That's maybe 1% of the services out there.
Right. I commend you for that, because I got when I first started trading. I first started trading about a couple years ago, so 2019, I would say. So like 2-3 years ago. And I paid for this service, monthly subscription. And the guy like completely ghosted. Like after a couple of months, he was just gone. Like I couldn't even get in contact with him. And I'm like, oh my gosh, I spent all this money on this guy, there
are a lot of them. It's also why when I'm posting, I used to post my daily P&L over an extended period of time. I stopped doing that simply because it gives an unrealistic picture of profitability, and a lot of people they're not understanding that if I make $13,000 in one day, that could have been $20,000 to $25,000 in capital I used on a highly risky trade to make that capital. Yeah. So it gives an unrealistic picture. And also a lot of people see it, and it makes them feel bad that they're not able to do that themselves. So I decided I would just, at times, I'd post my percentage gain and leave it at that. And and I typically do it in the form of a video. A lot of what people post is completely fake, completely fabricated numbers. And I also generally would show my entries and my exits and the actual order fills, whereas most people don't show that at all. And that's because they're selling a service. And a lot of times, I even had one trader tell me about another trader that the person actually had a couple of different accounts, and what they would do is they'd buy call options on something. They'd simultaneously buy put options in another account. So the put options would lose a bunch of money. The call options would make a bunch of money. And they'd post the call option win, say, hey guys, look at what I did, to try to get more subscribers to the person's service. And meanwhile, their profitability was 0 to negative or almost nothing because they're playing both directions. But that's how big, that's how much money can be made if you get some subscribers. You think you get 1,000 people. If you get 1,000 people paying $100 a month, you're bringing in the cash. So there's an incentive to lie, and it needs to be regulated. And there have been some big, there have been some big lawsuits. Hello, are you there? Did I lose you? Okay, I just opened up another browser and I couldn't see you. Okay.
Yeah, it's so bad. It's so bad, especially like being on Instagram. Like, I don't sell anything. I just have my podcast. I just want to like make more people aware of trading and to learn different strategies. I interview different people who trade, and they have different strategies and different life lessons that people could take. Like, I don't sell anything because I just want people to learn. Like, I have people that message me all the time, like, hey, how much would you charge to mentor me and things like that? And I'm like, trust me, I don't want to do it. The only thing that I'll probably do is focus on the trading psychology aspect, like really getting people to understand that and to invest in learning about it, because once you can control your mind, all your actions and your reactions to trading can lessen. But yeah, these traders, oh my gosh, I see it all the time. People DM me saying this person's a fraud.
I get those all the time, and it's I get a lot of people asking me what they think about somebody because the marketing was so good that they want to actually subscribe to the person's service. So somebody sent me a particular person's Instagram page. I took a look. The person showed all these wins and showed 0 losses. I said, well, that's a glaring sign right there that the person is a fraud, because no matter how good one is, they're going to lose. They're not going to have all wins. And ended up, I saw the person had teamed up with a couple of other people, and one guy had claimed to make $2 million on a particular day. And I just looked, I looked at that particular day, and for him to have made almost $2 million on a particular day, he would have had to have traded 90% of the option contracts on the stock that he claimed to have made $2 million on a particular day. And
math on math.
Which would not have been the case. It was just completely... It was for the sake of trying to get more subscribers.
The math ain't mathin'. That don't make sense. Yeah, I have a whole episode on that on my Discord or on my podcast where I talk about like the dangers of Discord signal trading and trading.
I'll have to take a look. I'll have to listen to that because I'm sure that's a good, very good podcast. But and definitely needed, because there's so many people who they might only do it for a couple of months, but you blow a couple of $100. But there's others who, they're taking $1,000 classes to $5,000 classes taught by con men who did very good marketing and have elaborate websites, and they still can't trade. And so many of them follow me, and they're saying, "Hey, what am I doing wrong?" And much of it comes down to they were taught some basic techniques that, in many cases, can work. But like anything, someone could teach you how to shoot a basketball, but you're not going to be able to make the shot consistently unless you practice with proper form. So while some of these folks do actually teach some good techniques, lack of practice, lack of using a proper daily trading plan under the proper conditions basically makes the education almost worthless.
Yeah. Yeah, I do. I agree with you on the fact that it should be regulated or something. Like, something's got to happen, but all they have to do is say, "I'm not a financial advisor," and then, like, it's a free-for-all. But, you have I in my podcast where I talk about it, I say, it's just a rite of passage. You're going to get got. You're going to get got. Like, when you first started out, you're going to get got. You're going to believe in this person or this service, and you're going to spend all this money, and then you're going to find out that it's not successful. And not only that, but just like even signal chats as it is. I was reading a book called Market Wizards, where it was this trader. He's a successful trader now, but he was talking about following this trader's signal chat, and the guy that would signal out the trade would make all this money on it, and he'd lose all this money on it. And the reason being was because you gotta have your own plan. Like, you can't follow someone else's plan. You don't know why he got into that trade. Why did he get in the trade? Is it a breakout trade? Is it a supply and demand trade? Is it like you do your ATR trailing stop? You don't know why he got in the trade. You don't know his exit strategy. So when he got into the trade, he knew what he needed to do to make money. And the person that followed his trade lost money because he didn't know when to get out, and he lost all his money. So signal chats aren't, teaching you anything. They're just, it's like copy paste, and you're not going to be successful in it. Like, you're not going to be successful. You have to learn how to do it yourself.
One thing that happens with those signal trades, if somebody puts out a signal to buy something, say he has 1,000 followers, and 75% of them, or even 50% of them, do the same trade. Well, that helps push the price that particular direction. And then the person sells and puts a signal out to sell. Well, now all those people are selling at the same time, helping drive the price down. So signals can benefit the person who puts out the signal far more than they benefit the people who get the signal.
Right. Yep. I agree. Something's got to give. Hopefully something changes in the next couple of years in terms of laws and regulation on who can. I mean, I don't know. I don't know how you regulate it. I really don't know how you regulate it.
It could be regulated. It's just, it's not a priority. It could be, they could simply require somebody to be a financial advisor, a registered financial advisor, to have a trading signal service or some other type of classification. But it's not a priority. And, and people have to, if it's too good to be true, it usually is too good to be true. People have to use common sense, and even if it were regulated, you'd have some guys over in the Ukraine somewhere where U.S. law cannot impact them, and they could offer the same thing
and make money and make bank. Right. So. Yeah, using discernment, common sense, save you a lot of money in trading. Well, Thank you, Greg, for coming to sit and talk with me about your trading journey and your strategies and the things that you've learned along the way. I really appreciate
You're welcome. My pleasure. Thanks for having me.
All right, everyone, that's a wrap for this episode of the BlackGirlOption Podcast. I hope you gained some insight and learned something new. Don't forget that episodes drop every first and third Monday of each month. So please hit the follow button and follow me on Instagram at BlackGirlOption. See you all on the next episode.